Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Latham Group Inc. Annual Report. Latham Group Inc. offers a diverse range of businesses and services that cater to the needs of residential swimming pool owners. The company's primary focus is on designing, manufacturing, and marketing in-ground residential swimming pools across North America, Australia, and New Zealand. The company provides a portfolio of pools and related products under various brand names, including Latham, Nairlin, Coverstar, Radiant, and GLI. This extensive range includes fiberglass and packaged pools, as well as pool covers and liners. These offerings enable homeowners to choose from a variety of options that suit their specific needs and preferences. By providing high-quality products and services, Latham Group Inc. has established itself as a leading player in the industry. With its headquarters in Latham, New York, the company has been serving customers for over 65 years, demonstrating its commitment to excellence and customer satisfaction. The Latham Group Inc. Swim stock price has experienced a significant decline of -14.21% over the past year, but a clear cause for this drop remains elusive. Despite fluctuations in its stock performance, no specific news event or earnings report can be pinpointed as the sole reason for such a substantial single-day or short-period decline. The company's quarterly earnings reports have been mixed, with some meeting expectations and others missing forecasts. However, none of these events led to a drop exceeding 14.21%. The Q3 2025 earnings report was the closest, but it only resulted in a 0.96% decline in stock price. Even the Q4 2025 and full year 2025 earnings report, which beat EPS and revenue estimates, saw a 2.42% decline in aftermarket trading. The overall change in Latham Group Swim stock over the past year was -4.38%, with general trough market conditions in the U.S. in-ground pool market throughout 2025 contributing to its weakness. Despite these factors, no specific news event directly led to a drop of over 14.21% in a single instance during the specified period. Latham Group Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $1 billion. Latham Group Inc. trades at a higher price-to-book ratio of 1.86 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 51% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline are multifaceted and influenced by various internal and external factors. On the growth side, key drivers include the shift from concrete to fiberglass pools, expansion into new geographical markets through strategic partnerships, and investments in innovation and product development. Additionally, the company's strong distribution network, long-term relationships with top dealers and distributors, and significant investment in partnerships have contributed to revenue growth. The company has also experienced historical growth in fiberglass pool sales due to its investments in innovation and product development, which is expected to continue with potential for further margin expansion. Replacement demand for vinyl liners and increasing demand for automatic safety covers driven by local building codes and homeowner preference are other significant drivers of revenue growth. On the decline side, factors such as decrease in inventories, increase in incentive compensation, inflationary pressures, severe weather conditions, and impairment of equity method investments have contributed to revenue decline. The company's decision to align with demand has led to a decrease in inventories, while increased incentive compensation and inflationary pressures have also had an impact on revenue. Overall, the company's revenue growth is driven by its strategic partnerships, innovation, and strong distribution network, while revenue decline is influenced by factors such as inventory management, incentive compensation, and external market conditions. Net income and profit margins. A shift towards stability in a significant turnaround. Net income transformed from a loss of -$2,388 in 2023 to a profit of $28,984 in 2025. This remarkable shift was preceded by a decline in net income from -$2,388 loss in 2023 to -$17,860 loss in 2024. The improvement in net income can be attributed to various factors such as changes in revenue mix, cost structure, and operating efficiency. Profit margins also experienced a notable increase during this period. Adjusted EBITDA margin rose from 15.8% in 2024 to 18.3% in 2025, while gross margin increased by 3.2% from 30.2% in 2024 to 33.4% in 2025. The net income margin also improved significantly, jumping from -3.5% in 2024 to 2% in 2025. These improvements in profit margins suggest that the company has become more efficient and effective in its operations. The company's financial performance indicates a consistent trend of generating positive operating cash flow. According to the data on page 46 and page 59, the net cash provided by operating activities has been steadily increasing over the past 2 years. In 2024, the company generated $61,307 in net cash from operating activities, while in 2025 this figure rose to $63,430. This upward trend confirms that the company is successfully managing its operations and generating sufficient cash flow to support its growth. The company's debt level and interest expenses have undergone significant changes over the past few years. Initially, there was no mention of a significant change in debt levels on page 21. However, it increased significantly on page 26. The total debt decreased by $1,680,000 from $278,271 to $276,591 on page 55. In terms of interest expenses, the company experienced fluctuations due to variable interest rates and higher leverage. On page 26, interest expenses increased due to unfavorable interest rates. However, it decreased by $965,000, -0.2%, on page 40. The interest expenses also saw a significant decrease of -16.1% from 2023 to 2025. The company's interest expenses have been steadily decreasing over the years. In 2023, the interest expenses were at $30,916,000, which decreased to $24,840,000 in 2024, and further decreased to $25,805,000 in 2025. This indicates a downward trend in interest expenses over the past few years. The performance of various regions and segments within the company has been a mixed bag. On the positive side, North America has maintained its leading position in every product category, driven by strong demand for fiberglass pools. Australia and New Zealand have also seen robust demand for fiberglass pools, while Western Europe boasts a higher penetration rate of fiberglass pools compared to the US. In contrast, international operations have struggled, accounting for only 15.4% of net sales in 2025. This underperformance is a concern that needs to be addressed. Looking at specific segments, fiberglass pools have been a standout performer, taking market share from traditional concrete pools. Auto covers have also done well, thanks to successful efforts to drive conversion and completed acquisitions in 2025. However, concrete pools have struggled, losing ground to the more popular fiberglass option. Management is optimistic about the company's performance and expects continued growth in the fiberglass pool market. The company will focus on exterior living spaces, driven by macroeconomic factors, and see significant growth potential in the fiberglass pool market. To achieve this growth, management plans to execute key strategic priorities, including building the Latham brand and driving adoption of fiberglass pools and auto covers. They expect to outperform the U.S. in-ground pool market and expand branding and marketing efforts in sand state markets. the company will also devote significant resources to developing innovative new products and expanding market share through acquisitions. Additionally, management plans to deploy capital opportunistically for profitable organic and acquisition-related growth, while delevering and reducing their net debt leverage ratio. Overall, the company's strategy is centered around driving growth in the fiberglass pool market, building the Latham brand, and expanding market share through innovative products and strategic acquisitions. The company has a history of rewarding its shareholders through various means. One such way is by paying dividends, which it has done in the past despite being restricted by a credit agreement. This indicates that the company values its shareholders and is committed to providing them with returns on their investment. In addition to paying dividends, the company has also implemented a stock repurchase program. Approved in 2022, this program allowed for the purchase of up to $100 million worth of shares over a 3-year period. The program came to an end in May 2025, marking another way in which the company has sought to benefit its shareholders through share buybacks. Concerns about inventory buildup or supply chain disruption are evident in various sections of the report. One major concern is the reliance on global third-party suppliers, which can lead to delays or disruptions caused by enterprise resource planning system implementation, page 13. Additionally, tariffs on raw materials may limit availability and increase costs, posing a risk of higher costs and inadvertent noncompliance associated with imported products, page 15. The report also highlights the potential for supply chain disruptions due to various factors such as transportation disruptions, page 22. Changes in fuel prices or work stoppages, disruption to transportation routes, and changes in tariffs or duties imposed on imported products or raw materials. Furthermore, the dependence on global suppliers and limited ability to arrange alternative sources of materials in case of shortages is a significant concern, page 19. The inventory levels also indicate potential issues related to inventory buildup. The report shows a decrease in inventories from $22.7 million in 2024 to a decrease of $2.8 million, which may not be sufficient to offset an increase, page 46. Moreover, there is an inventory buildup mentioned with finished goods increasing by $3.7 million from 2024 to 2025, page 73. Overall, these concerns suggest that the company may face potential issues related to inventory buildup and supply chain disruption, which can impact its operations and profitability. That concludes the financial summary for Latham Group Inc. Feel free to comment below, and I will be happy to answer them when possible.